You know, if you have a 401k, chances are you are automatically put into some kind of default investment. It's designed to be easy, right? You just set it and forget it. But what if that default setting, the one that's supposed to be safe, is actually one of the biggest risks you can take with your future? We're going to get into that right now.
So, let's just ask the question point blank. You've been saving your whole life, trusting the system to do its job, but is that money you're counting on actually protected for when you need it the most?
And look, most people just assume, yeah, of course it's safe. I mean, it's often called the qualified default investment alternative. It sounds so official, so government approved. It's the standard option, picked by experts, so it has to be okay, right? Well, that assumption has been proven to be dangerously wrong. To really understand how this happened, we need to go back in time to a specific moment that just shattered this illusion of safety for millions of people who were just about to retire.
30%. Just look at that number for a second. Imagine your entire life savings, everything you've worked so hard to build up, and then boom, a third of it just vanishes.
Well, that's exactly what happened back in 2008. The target date funds for people who were literally on the cusp of retiring, we're talking about the 2010 funds, they lost more than 30% of their value. Now, this wasn't just some temporary dip for a 25-year-old with decades to recover. For people right on the finish line, this was absolutely catastrophic.
So how on earth could a supposedly safe fund fail so spectacularly? Well, the problem is baked right into its fundamental design. It's a one-size-fits-all approach that, when you look closer, actually fits almost nobody correctly.
And this really shows you who's most at risk. See, the data shows that 62% of people in these plans are accidental investors. They're not actively choosing anything, they just go with the default option because they trust it's the right thing to do. And that trust, unfortunately, is what makes them so vulnerable.
And this right here is probably the single most important idea to understand, the risk zone. Think of it as this critical window, maybe 5 to 10 years before you retire and the few years right after. A big loss during this period is not just a little bump in the road. It's something called sequence of return risk, and it can permanently cripple your financial future because you have zero time to make it back.
As Surz from Target Date Solutions puts it, the human cost is just staggering. This isn't just about charts and numbers, it's about people's dreams and their entire sense of security getting completely upended at the absolute worst possible time.
Okay, this slide just lays out the problem perfectly. On the left, you've got the industry standard. On the very day you plan to retire, their safe fund has you 85% invested in risky stuff, like stocks. It's unbelievable. Now look at the right. A safety-first design flips that completely, with the majority of your money in safe assets to protect what you've built. The big takeaway here? The industry default is built for risk, not for safety.
So if that generic one-size-fits-all model is so broken, what's the fix? Well, it's not about finding a slightly better generic path. It's about shifting to a totally different way of thinking, personalization.
The real solution here is recognizing that your financial goals, your comfort with risk, they're unique to you. The answer is to give you, the investor, actual control over your own retirement journey instead of just forcing you down a path that was designed for a faceless, anonymous crowd.
And now, a new generation of tools is making this possible. So let's take a look at how a personalized approach, like the one offered by a platform called Soteria, actually puts this idea into practice.
Instead of that rigid one-way street, it becomes a really simple three-step conversation. First, you choose your risk level, not what some fund company thinks it should be. Second, you select your target retirement date. And third, your trusted financial advisor implements a glide path that is truly yours. It puts you right back in the driver's seat where you belong.
The advantage here is pretty clear. You get a path that's actually tailored to your personal comfort level. And this isn't just for a company 401k. It works perfectly for individual retirement accounts, IRAs too. The whole system is flexible. And most importantly, it creates a real partnership between you and your advisor to get you through that critical risk zone safely. And that partnership idea brings us to the final and maybe the most crucial piece of the puzzle. To make all this change happen, to move away from this flawed default system to a truly personalized plan, there's one group that is right at the center of this retirement revolution.
And that is your financial advisor. They are the absolute key to breaking this cycle of one-size-fits-none investing. They are the ones who can put these personalized solutions into action and take real fiduciary control to protect their clients from ever seeing a repeat of 2008. And for advisors, this is a total game changer.
They can finally bring the real science of lifetime investing to their clients. They can take direct control of the investment glide path and help you whether your money is in a company plan or an IRA. It lets them offer a genuinely superior alternative to the flawed defaults that are everywhere.
So we'll leave you with this one question. After saving for an entire lifetime, you absolutely deserve a retirement path that's built for your specific journey, not one built for the masses. So is your plan designed for everyone else, or is it finally time to demand a plan that's actually designed for you?